all heard about the magic of compounding, how small actions and small decisions can compound into massive gains. But today we're going to flip the script. We're going to delve into the dark side of compounding, how seemingly harmless actions, or rather inactions, can actually compound into a wealth-wrecking snowball. Buckle up as we explore 7 surprising ways that your money might be working against you. Hey guys, it's Karthik, your financial wingman, and today we're going to talk about the curse of compounding, negative compounding. The most common and the one that most people fall prey to is the credit card monster. Now, credit cards are perhaps the most convenient and easy tool for us to use in our everyday lives, and that monster is paying minimum payments. Now, every time you get your credit card statement, the first thing that is staring in your face is the minimum amount due. And most people think that it's okay to just make this minimum payment. So for example, if your credit card bill is $2,000, then the minimum amount that you will have to pay is about 2 to 5%. So let's say $100 a month. Now take a look at this. I've pulled this straight out of my credit card statement. Let's say your outstanding balance is 2,000 dirhams and the minimum that you have to pay on this is 5%, which is $100. The monthly interest rate is 3.25%, which if you see here says 39%. But since this is a monthly interest rate, this actually compounds on a monthly basis if the full balance is not paid, which means you could be paying in excess of 45%. If you just hold on to this and keep paying $100 a month, the payment will take you 31 months to complete. Just 2,000 dirhams would take you 31 months and you'd pay interest charges of over 1,100 dirhams. But as the numbers get bigger, this gets even scarier. Let's say you're carrying a 10,000 dirham balance, which is approximately $3,000. It would take you over 10 years to repay this if you just paid the minimum balance, and you'd pay over 16,000 dirhams only in interest. But the real problem is that we don't just stop at that 10,000. Let's say you start making your minimum payments, but every month you keep adding to this outstanding balance. Let's say you just add 2,000 dirhams every month to your outstanding balance and keep paying only minimum payments. In 5 years, you will have over 75,000 dirhams of credit card debt. And in 10 years, this will be over 100,000 just because you're only making minimum payments and the amount that is unpaid gets charged at 45% annually. And if you're shocked hearing this, trust me, it happens more often than you think. I've put a free tool in the link below. Check it out, it's absolutely free. It will give you a good sense of how long it would take given your credit card balance and how important it is to pay your credit cards every month in full. It's very simple, just put a standing instruction so that your entire credit card balance gets paid before your due date. And so if you're not careful, a 10,000 debt will magically compound into a $100,000 debt in just 10 years. The next one is the procrastination pitfall. Now most people delay their investments for various reasons. Either they're too busy partying in their 20s, or they just have too much fear, or the lack of knowledge, or whatever the case may be, or they just never get to it. And I'm going to take you through a few examples just to show you how negatively compounding can impact you and your financial future just by delaying investments. Let's say you start investing $100 a month at the age of 20. And you invest this and it starts compounding at 10% per annum every year for the next 40 years till the age of 60. You would have accumulated over $630,000. However, if you started investing at the age of 30, still investing $100 a month, you would end up with just over $225,000. Let's say you delay this even more and you start investing $100 at the age of 40. By the time you're 60, you would have only $75,000. If you delay this even further, just for the sake of numbers, at the age of 50, if you started investing $100, you would end up with just over $10,000. And this is how compounding can really work against you if you keep delaying your investments. So get started as early as you can. And just for fun, check this stat out. If a kid is given $10,000 at birth, and this $10,000 is invested in the S&P 500, which is an index which tracks the largest 500 companies in the United States. If this $10,000 was invested in the S&P 500 at a 10% return, by the time this kid was 65, he would have close to $5 million. That is how compounding works, and if we don't take advantage of it, it's actually going to work against us. Number 3 is lifestyle creep. As we get older and start earning more money, we have a tendency to expand our lifestyle to incorporate this higher salary, which basically means that we buy a bigger car when we get a pay raise, we move into a bigger house, we buy more house than we can afford. And what comes with this is a lot of ancillaries. When we have a better car, our EMIs are more, it requires more fuel, it requires more money to maintain, it requires more for insurance. Overall, our costs start compounding. We might just think that our EMI is increasing by a few $100. But what happens is all the costs associated with that start increasing. And this compounds over time because now we've set a new base, we've set a new benchmark. We can't go below this. So as we go along in life, these costs start compounding and it takes a massive toll on what could have actually been invested. So the simple message here is don't fall for lifestyle creep, or at least be aware of lifestyle creep. When we buy a bigger house, we got to put in more furniture, we got to pay more electricity, we got to pay more utilities. The costs will keep increasing the more we fall for lifestyle creep. And this is a negative compounding effect because all this money essentially should be going into our investments, which will compound positively over time. Number 4 is timing the market. Now today we have so much of access to our investment accounts, our trading accounts. With the click of a button, we can see whether our portfolio is up or our portfolio is down. We have so much access to news. We keep hearing about the world is going to end, or recession's coming, or the Fed is cutting interest rates, or whatever else is going on. We have so much access to news. So we think we start processing all this news and information and start taking decisions based on it. So during times of recession, when we see our portfolio is down 10, 15, 20, 30%, what do we tend to do? We tend to get out and sell our positions or sell our investments. Or let's say we are holding on to cash and we think that once the market falls, that's when we'll get in. We try to buy at the low and sell at the high. But what tends to happen is exactly the opposite. We end up buying at the high once all the news is already in the market, everyone else is buying. And when there is fear in the market and the market is at the absolute low, that's when we end up selling. Now this has devastating results on our long-term growth. This is where negative compounding again can absolutely destroy our financial future. Because what happens is, instead of staying consistently invested, buying every month, doing an SIP, or being consistent with our investments, we try to time the market. We think that we know what's going to happen. No one knows anything about what's going to happen. Otherwise, economists and forecasters would have been millionaires. Stick to the basics. Buy a simple index fund or an ETF. Buy it every month. Put a standing instruction and don't deviate from that. Don't try to time the market and stop opening your investment account every single day. I know I have fallen for it multiple times. I keep checking my investment account, but that is something that we need to avoid if we want to ensure that compounding works in our favor. The next point is the fee fiasco, which is paying high fees on your investments or to your investment manager. These are essentially fees that we pay an investment manager or a financial advisor to manage our money actively. This could range anywhere between 1% to 3% depending on what kind of product or what kind of platform you're using. Now this by no means is financial advice, and I'm sure there's a place and a time for a financial advisor, but I'm just here to show you the numbers and tell you what you need to be aware of. Let's say you invest $10,000 every year and you pay a 2% fee on your account. This could cost you upwards of $500,000, $500,000 in the next 30 years. Again, to work out the numbers for yourself and to see how much money you could be losing to investment advisory fees, check out the tool in the description below, put in your numbers, play around with it, but just be aware that if you're paying a high fee on your investments, this could be a massive drag on your returns in the long run.
For most of us, buying a simple ETF or an index fund with an extremely low expense ratio is a great place to start.
Number 6 is the illusion of security, which is sitting on too much cash. The first time I came across this was actually when I realized that my own mother, till just a few years ago, was just collecting cash. She used to feel so good when she would open a bank account and see those numbers just adding up month after month. That for so many years, she didn't invest a single penny. She didn't buy real estate, she didn't put it in the stock market. She just felt good that this money was accumulating in her bank account. Now what we need to realize is that when money is just sitting in your current or your savings account, you're getting paid close to 0% on that money. That means that this money could have been better utilized somewhere else. And I know a lot of other people who, in the process of buying a house or just because they didn't know where to invest, allowed that money to sit in their bank account at 0%. Also, a lot of times we feel that we need to have cash. All the cash that we need to keep with us is our emergency fund, which is maybe 3 to 6 months of our expenses. Beyond that, you need to start building assets. Assets either for growth or for creating income. Of course, we are living in uncertain times, and maybe you feel that today is a time you want to keep more cash with you. But even that money should be in a high yield savings account. Today, there are so many options where there are digital banks paying you 5-6% interest on your money. Take advantage of it and don't just allow your money to sit in your bank accounts. Point number 7 is inflation cash burn. Now, leading from the previous point that we just spoke about of holding excess cash, here are some simple numbers that we need to keep in mind. Over the last 25 to 30 years, the average rate of inflation has been between 2 and 3%. Now, just to tell you what that means, let's say you're sitting on $1 million today at an inflation rate of 3%. Over the next 10 years, your $1 million will only be worth $750,000. And if you keep sitting in cash, in 25 years, it'll be only worth $450,000. Just imagine, in 25 years, if you don't invest your money and keep sitting in cash, just inflation will start eating into your money year after year after year, where you'll be left with less than half in just 25 years. So beware of inflation and get your money to start working for you instead of working against you. The minute we become conscious about where we're spending our money, it's the easiest thing to cut a couple of $100 every month and invest that money. And remember that not being conscious of all these above points and where your money is going could be the biggest snowball that is coming your way to destroy your financial future. Make sure to start implementing these small changes in your life. Make sure that compounding is working for you and not against you. Make sure to share this video with someone who you think will benefit from these points, and I will see you right here.